Have you ever looked around at all the buildings, the land, and just wondered how people actually invest in that stuff? I mean, not just buying a house to live in, but really making it part of a wealth building plan. Today, we're doing a deep dive into Real Estate Investing 101. Our goal here is to really pull out the key insights from your sources on real estate, sort of give you a shortcut to getting well informed. We'll look at why it's such a big deal for investing, the different ways you can actually get involved, and how to handle the unique upsides and downsides.
Yeah, it's fascinating, isn't it? Just how fundamental real estate is. It's tied into our economy, our daily lives,
Hmm.
everything. The ground we stand on, the buildings we use. Understanding how to invest in it gives you this unique view on building wealth and, well, the whole economic picture. It touches everything.
Okay, so let's start right there. Why real estate? I mean, your sources seem to consistently put it up there as like one of the most profitable, least risky, most stable options. And the thing that really jumps out, for me anyway, is that it's tangible. Unlike stocks or bonds or something totally abstract like Bitcoin, you can see it, touch it, stand on it, it feels real. Which means you've still got something valuable even if the market, dips. You can even use it for something else, maybe grow food or whatever.
Yeah.
But beyond just being physical, what's maybe the most overlooked advantage, something that maybe traditional stock investors don't always get?
Well, if you connect it to the bigger picture, I'd say it's this combination of being immobile and scarce. Real
Yeah.
property's value is just so deeply tied to where it is. You can't pick it up and move it.
Right.
And you can't just make more land. There's a finite amount of usable space, and that's a huge driver for appreciation over time. It's a truly fixed resource. Beyond that, it's fantastic for diversification. It helps smooth out the bumps in your portfolio because real estate doesn't always move in lockstep with, say, the stock market.
Okay.
And it can be a really powerful hedge against inflation. Think about it. Property values, rents, they tend to go up when inflation goes up. So landlords can often pass on those rising costs, especially if they locked in a fixed rate mortgage years ago.
Oh, smart.
Then there's control. You have way more direct influence than with like a stock certificate. You
Yeah.
can physically improve the property repairs, renovations, additions to increase its value, and you can directly impact the income by choosing good tenants, raising rents appropriately. Of course, that control means more active work.
Sure. It's hands-on.
And finally, leverage. This is huge. You put down a relatively small amount, maybe as little as 3.5%, borrow the rest, but you control this large asset.
Uh-huh.
And you get all the benefits, the income, the tax write-offs, as if you owned it outright. It really lets you amplify your investment power.
That idea of leverage, yeah. Controlling a big asset with a small down payment, that's incredibly attractive. But I imagine taking on that much debt can feel scary for newcomers. What's
Yeah.
the biggest mistake people make with leverage?
Probably failing to properly budget for the carrying costs when it's empty, or for those sudden unexpected repairs. Leverage boosts your gains, absolutely, but it also boosts your losses if you hit a rough patch, like a few months without a tenant or needing a new roof.
No.
You're still on the hook for the full mortgage, the taxes, the insurance, whether you have income coming in or not. That's why having enough cash reserves is just critical.
Excellent point. Okay, so we've got the why. Let's shift gears to the how. The different kinds of real estate out there. Let's start with the absolute basic. Land. And when we say land, it's more than just, empty lots. It's working land too. Farms, ranches, timberland, plus anything naturally on it, like trees, water, oil, minerals, whatever. Your sources also talk about unimproved land. No basic services like power or roads,
Yeah.
but you still often pay property taxes on it. And then there's land in development, which is being prepped for something specific.
Right, and this brings up a key question. How do these different types fit different investment goals or risk levels? If you look at it purely from an investment angle, commercial often has some advantages over residential. Generally, you get more stable cash flow, those longer leases you mentioned, 5, 10 years sometimes. More units often mean more potential cash flow overall, and you get economies of scale. Managing multiple units in one building is often cheaper per unit. Now, buying commercial directly takes serious cash up front. So a lot of beginners get into it through things like REITs, real estate investment trusts, or maybe crowdfunding platforms.
We'll come back to those.
Definitely. Then you've got industrial real estate.
Yeah.
Very appealing because of those long-term leases leading to really steady, stable income. This is where the backbone of the economy lives, right? Manufacturing, warehouses, shipping centers. And it can be flexible. A warehouse might have office space built in. Often high income potential, lower relative costs. Those locked-in leases mean vacancy rates are often lower too. We also see retail strip malls, grocery stores, big box places, shopping malls. Your sources make a good point that, real life shops offer a lot that e-tailers just can't. That sensory experience, human
It's
interaction.
true.
And finally, medical properties. Everything from a single doctor's office up to hospitals, long-term care facilities. That sector's growing, driven by the aging population, and demand tends to stay strong regardless of what the economy's doing.
Okay, so with all these options, what does it actually mean for you if you're thinking about owning property directly, like being a landlord or maybe flipping houses? Let's start with rentals, choosing the right one. You're deciding between single-family homes or multifamily buildings. Single-family might be easier to get a loan for, maybe a less complex maintenance per unit, and potentially easier to sell later. Multifamily, though, you consolidate costs one roof, right? And you've got more potential for a stronger income stream, more diversification with multiple tenants. And then there's that clever trick, house hacking, living in one unit of, say, a duplex, and letting the rent from the other unit cover your mortgage. Makes financing easier, cheaper.
Yeah, that's a popular entry strategy.
Condos are also mentioned as potentially good starter properties. You mainly worry about the inside, the association handles the outside stuff. But whatever you pick, that market research is key, isn't it?
Absolutely critical.
Rentability, typical rent levels, and yeah, school districts, wow, up to a 58% bump in value. That's huge.
It really is. People pay a premium for good schools.
Plus, checking crime stats and just making double sure the costs, mortgage, taxes, insurance, upkeep, don't eat up all your potential rental income.
Mm.
Now, beyond the property itself, asset protection. This sounds important. Using a holding company, like an LLC or an LP.
Essential. It creates a legal separation between your personal assets, your house, your savings, and the liabilities related to your investment property. So if something goes wrong at the rental, say a tenant slips and sues, they sue the LLC, not you personally.
Ah, okay.
But, and this is a big but, you have to keep the finances totally separate. Business account, personal account, no mixing.
Right, no paying personal bills from the LLC account.
Exactly. If you pierce that corporate veil, the protection might not hold up in court. There are costs to set it up and maintain it, sure, but the peace of mind, usually worth it.
And even with the LLC, insurance is still the first line of defense, right? General liability, fire, maybe loss of income coverage.
Absolutely. Insurance first, LLC second. You need ample coverage. Think general liability, fire and hazard, definitely loss of income or rent loss insurance. Maybe an umbrella policy for extra liability protection. Tenant issues, storms. Then you need that safety net. Now, switching to the more active side, house flipping. There are different ways to do it. Fix and flip is the classic. Buy low, renovate, sell fast. Live in and flip means you actually live there while fixing it up, can save costs, maybe easier financing. And hold and flip is buying something undervalued, waiting for the market to rise, then selling, maybe with minimal repairs.
Okay, and the profits. I saw that $65,000 average figure, but
Yeah, but that's gross profit before
Yeah.
all expenses. And it's an average. Lots of people lose money or barely break even, especially after paying contractors, holding costs, closing costs.
right, averages hide a lot.
They do. Strategic pricing helps. Pricing at $219,000 instead of $220,000 just to show up in more online searches. Little things matter. Buying methods like foreclosures or tax sales can seem cheap, but they're risky. You can run into nasty hidden surprises. Oh, toxic mold hidden in walls, ancient plumbing about to burst, major foundation issues. I've heard horror stories.
Yikes.
Plus, sometimes those sales are cash only, or getting a regular mortgage is tough because of the property condition. When you're scouting locations to flip, look for that spark in a neighborhood. Are rents consistently going up? New public transit coming? Younger people moving in? Big retailers opening up? Your sources mentioned the Starbucks factor, which is kind of funny, but often true. If Starbucks is building there, they've done their homework.
Interesting indicator.
Conversely, watch out for negative catalysts. A big local employer shutting down rising crime rates. Those are red flags.
And financing these flips. Sounds like cash is preferred.
Cash is definitely king. Building up a good cash reserve is crucial. Traditional banks, if they lend on flips, usually want at least 20% down. That avoids PMI, too.
PMI, private mortgage insurance.
Right. But often, flippers turn to hard money lenders or private lenders. They're faster, less paperwork usually, but the price is much higher interest rates, often upfront fees called points, and they might only lend 50% and 70% of the property's value, the loan to value or LTV. So you still need significant cash.
Okay, so if all the leaky pipes, the tenant calls, the contractor chasing sounds like, well, a headache, but you still want those real estate benefits. There are ways to invest without getting your hands quite so dirty, right?
Yeah.
Indirect investing. Let's talk REITs first. Real estate investment trusts.
Exactly. REITs are basically special companies whose main business is owning, operating, or financing income-producing real estate. You've got equity REITs, they own properties, collect rent, benefit from appreciation, think shopping malls, apartment buildings, office towers. And debt REITs, they're more like banks, providing financing, holding mortgages. The key thing is, to qualify as a REIT and get tax advantages, they have strict rules, like at least 75% of their assets and income have to come from real estate. And this is great for investors. They have to pay out at least 90% of their taxable income as dividends each year.
Oh, wow, 90%.
Yeah. So the benefits are pretty clear. You get access to large-scale, often commercial properties that you could never afford on your own. You get a potentially reliable income stream from those dividends and often pretty steady cash flow, even if the economy slows down a bit. And you can buy REITs focused on specific sectors like retail or medical if you have a view on those industries.
Okay, REITs sound like a good starting point for indirect. What else?
Well, similar but broader, you have real estate mutual funds and ETFs, exchange-traded funds. These funds basically bundle together a whole basket of real estate securities, often lots of different REITs, maybe some real estate company stocks, instant diversification.
Right.
ETFs are particularly popular. They trade on stock exchanges just like regular stocks, so they're easy to buy and sell throughout the day. Plus, they usually have really low minimum investment amounts and low annual expenses, which is great. Most real estate ETFs just hold a mix of REITs.
So ETFs are kind of like buying a bundle of REITs easily.
Pretty much, yeah. Then you can also invest directly in real estate-related stocks. Think about companies that support the industry. Home builders like Lennar or D.R. Horton, suppliers like Home Depot or Lowe's, furniture companies like Williams-Sonoma or Wayfair, even service companies like property managers or online platforms like Zillow.
Ah, interesting angle. Investing in the ecosystem around real estate.
Exactly. You'd research these companies like any other stock, look at their plans, performance, using tools like Yahoo, Finance, or Morningstar. Another option, real estate notes. You're essentially buying someone's mortgage. You become the bank.
So you collect the monthly payments.
Yep, you collect the principal and interest payments. Returns are typically in the, say, 5% to 9% range. To lower your risk, you want to look for notes that are senior, meaning they get paid first if there's a foreclosure performing, meaning the borrower is currently paying on time, and seasoned, meaning there's a history of on-time payments.
Okay, that sounds more involved. Need some homework.
It does. Then there are mortgage-backed securities, MBS. These are bonds backed by pools of mortgages. The payments from homeowners get passed through to the bondholders. You hear names like Ginnie Mae, Fannie Mae, Freddie Mac associated with these. Mostly bought by big institutions, though.
Right, maybe not for the average individual investor directly.
Probably not directly, no. But then there's crowdfunded real estate. This is newer. Online platforms connect investors like you with big real estate projects, office buildings, apartment complexes that you normally couldn't access.
So you pool money with others online.
Exactly. You can invest on the equity side, meaning you own a small piece of the property, or the debt side, meaning you're lending money to the project. The debt side is generally seen as less risky. Shorter terms, more predictable income, maybe 8–12% returns typically advertised. Platforms like Fundrise or Patch of Land are well known, but you really need to research the platform itself, its track record, fees, etc. Due diligence is key. You also have real estate investment groups or clubs, kind of like a private version of crowdfunding. A group buys a property, maybe an apartment building, and members can buy shares or individual units. Benefits are pooling money for bigger deals, sharing expertise. Maybe someone's good at bookkeeping, someone else at maintenance and learning together. Downsides, often very illiquid, hard to get your money out quickly. You might be locked in for 5 years or more. And, mixing money in groups of people can sometimes lead to emotional decisions or disagreements.
Yeah, group dynamics.
And finally, interval funds. These are interesting. They let regular, non-accredited investors get into assets usually reserved for the very wealthy or institutions. They aim for steady income and long-term growth. The catch is they're semi-liquid.
Semi-liquid, what's that mean?
It means you can't just sell your shares any day you want, like a stock or ETF. You can only sell back to the fund at specific preset times, maybe once a quarter. This protects the fund from panic selling during market dips, but means your money isn't instantly accessible. Minimum investments can be higher, maybe $2,500 up to $25,000, and they often have sales fees.
Wow, that's a really broad range of indirect options, from super liquid ETFs to these semi-liquid interval funds. If someone's just starting out, just wants to dip their toes in indirectly, What's the absolute best starting point? And maybe what should they avoid initially?
Yeah, good question. For most beginners wanting indirect exposure, REITs, probably through low-cost ETFs, are likely the easiest and best entry point. They're liquid, diversified, professionally managed. You don't need huge amounts of capital or specialized knowledge to start.
Okay, REIT ETFs, simple, liquid.
Exactly. On the other end, I'd probably steer clear of buying individual real estate notes or direct MBS initially, and maybe even be cautious with some of the crowdfunding debt deals until you really understand how to vet the specific project, the borrower, the platform's underwriting. They just require a deeper level of due diligence.
That makes a lot of sense. Start broad and simple, then maybe specialize later. Okay, stepping back again. It's clear real estate isn't just about the property itself. It's tied into the bigger world, right? The economy, population trends, government actions, these all play a huge role. Like the overall economy obviously has a massive impact. Things generally boom when the economy is strong, slow down when it's sluggish.
Hmm.
Although your sources do say some real estate can do well anytime, maybe even better in a downturn, like maybe discount retail or storage.
Potentially, yeah. Or rentals might see increased demand if homeownership becomes less affordable. And the economy has that cycle, right? Expansion, peak, contraction, trough. Different strategies might work better at different points in the cycle.
And beyond the broad economy, demographics seem huge.
Oh, absolutely. Changes in demographics, age, income, marriage rates, family size, jobs. These trends can shape the real estate market for years, even decades, especially residential. A really interesting one highlighted in your sources is the senior co-housing boom.
Senior co-housing, tell me more.
Well, as the baby boomers retire, there's this growing desire for communal living options for older adults. Not necessarily full-on assisted living, but communities where people can live independently but share resources, social activities, maybe some meals. It offers financial and social benefits.
Right, community without constant care.
Exactly. And apparently there aren't that many of these communities yet. The Co-Housing Association says only about 22 in the whole U.S.
Wow, that's tiny.
It suggests huge potential for growth. And from an investor's point of view, seniors often make very reliable, stable tenants. So developing or investing in these could be a really smart niche play driven by demographics.
Fascinating. And government actions, taxes, subsidies.
Big impact. Federal, state, local governments can definitely move the needle on demand and values. Think tax deductions for mortgage interest, tax credits for energy efficiency, subsidies for affordable housing. A really significant example recently is Opportunity Zones, OZs.
Right, I've heard of those.
Yeah.
Created a few years back.
Yeah, 2017. It's a program designed to spur long-term investment in economically distressed areas, low-income communities. To get the tax breaks, you have to invest through a special vehicle called a Qualified Opportunity Fund, or QOF. These funds have to put at least 90% of their money into projects within these designated zones.
And the tax benefits are?
Pretty powerful, especially for those with existing capital gains. First, you can defer paying tax on prior capital gains you invest into a QOF until the end of 2026. Second, if you hold the QOF investment for 5 years, 10% of that deferred gain is forgiven. Hold it for 7 years, it's 15% forgiven.
Okay.
And the biggest one, if you hold the QOF investment for at least 10 years, any capital gains you make on the QOF investment itself are completely tax-free.
Wow, tax-free growth after 10 years? That's huge.
It is. Now, it was initially geared towards wealthier investors and institutions, corporations, LLCs, REITs can all invest. But as these funds get established, it might create more downstream opportunities for regular investors too, perhaps through REITs or funds that focus on OZs.
Okay, taxes are clearly a huge piece of the puzzle here. You mentioned deferrals, forgiveness. Let's unpack the tax advantages a bit more. This seems like one of the biggest draws, but also kind of complex. Start with depreciation. Your sources called it an expense on paper that transforms into real-life cash. What does that mean?
Yeah, depreciation is one of the magic parts of real estate taxes. The IRS lets you deduct a portion of the cost of your investment property, the building part, not the land, each year over its useful life, 27.5 years for residential, 39 years for commercial. Even though you're not actually spending cash on this expense, you get to subtract it from your rental income when calculating your taxable profit.
So it reduces your taxable income, even if cash flow is good.
Exactly. It can significantly lower your tax bill, sometimes even creating a paper loss that can offset other income. It's this, like you said, rare beneficial disconnect.
And bonus depreciation, Section 179.
That's related, but applies more to personal property used in a business, things like appliances, furniture, maybe some types of improvements within the building. Section 179 lets businesses deduct the full cost of certain qualifying assets in the year they're purchased, rather than depreciating them over time. There used to be limits, but recent tax changes made 100% bonus depreciation possible for many assets, which can create a big upfront deduction, potentially even generating a net operating loss for tax purposes.
Okay, so depreciation lowers taxable income. What actually counts as income you have to report? Rent, obviously.
Right, rent payments are the main thing, but also things like fees for early lease cancellation, pet fees, application fees sometimes. Even if a tenant performs a service for you, like painting, in exchange for lower rent, the fair market value of that service counts as income to you.
Good to know. What about security deposits?
Security deposits generally don't count as income when you receive them, only if you end up keeping part or all of it to cover damages or unpaid rent later on. And there's that quirky 14-day rule. If you rent out your personal residence, the place you actually live, for 14 days or less during the entire year, you generally don't have to report that rental income to the IRS at all.
Huh. Short-term rentals for, like, a local festival or something.
Exactly. Now, on the flip side, the deductible expenses for a rental property are numerous. Pretty much everything you spend to own and operate it. Mortgage interest, property taxes, insurance premiums, any HOA dues, advertising costs, utilities tenants don't pay, repairs and maintenance.
Repairs and maintenance, what's the difference?
Good question. Repairs are things that keep the property in good operating condition, but don't add significantly to its value or life. Fixing a leaky faucet, patching drywall, those are deductible immediately. Maintenance is routine stuff, pest control, landscaping, trash pickup, also deductible. Major renovations or improvements, however, things like a new roof, a full kitchen remodel, those are considered capital expenditures. You can't deduct the full cost right away. Instead, you add the cost to your property's basis and depreciate it over time, just like the original building.
Okay, repairs deductible now, improvements depreciated later. Got it.
Now, what if your expenses, including depreciation, are more than your rental income? You have a loss. The IRS generally considers rental real estate a passive activity, and passive losses can normally only be used to offset income from other passive activities.
So if I only have job income, which isn't passive, I can't use my rental loss.
Not usually, no. The loss gets suspended and carried forward to future years. You can use it then if you have passive income or when you eventually sell the property. But, and this is crucial, there are exceptions. If you actively participate in managing your rental, meaning you make key decisions like approving tenants, setting rent, approving repairs, and your income is below a certain threshold, you can deduct up to $25,000 of rental losses against your ordinary income, like your job earnings.
Ah, okay. That's a big deal for smaller landlords.
It is. And if you qualify as a real estate professional, according to the IRS's specific tests, which involve spending a significant amount of time on real estate activities, you might be able to deduct all your rental losses against other income without the $25,000 limit.
Okay, requires real commitment then.
Definitely.
Okay.
Now, this raises the question, what about taxes when you sell a rental property for a profit?
Right, capital gains.
Yep. Long-term capital gains profits on assets held for more than a year are taxed at lower rates than ordinary income. Currently, 0%, 15%, or 20%, depending on your overall taxable income. Much better than regular income tax rates.
But is there a way to avoid paying even that capital gains tax? I think I've heard of something.
Ah, you're thinking of the 1031 exchange, also called a Starker exchange or like-kind exchange. It's often called the Holy Grail for serious real estate investors.
Holy grail. Sounds powerful.
It is. Section 1031 of the tax code allows you to sell an investment property and defer paying capital gains tax on the profit if you reinvest those proceeds into another like-kind investment property within a specific time frame.
Like kind. Does that mean I have to swap an apartment building for another apartment building?
Not necessarily that specific. A like-kind for real estate is interpreted very broadly by the IRS. You could potentially exchange raw land for a rental house or an office building for apartments. The key is that both properties must be held for investment or productive use in a trade or business.
Okay, and the time frame?
It's strict. From the day you close the sale of your old property, you have only 45 days to formally identify potential replacement properties in writing. And you must close on the purchase of one or more of those identified properties within 180 days total from the initial sale date.
45 days to identify, 180 days to close. Tight deadlines.
Very tight. And you typically have to use a qualified intermediary, a third party who holds the sale proceeds. You can't just take the cash yourself. It allows investors to continually trade up to bigger or better properties, deferring taxes along the way, letting their equity grow much faster.
So you just keep rolling the gains over.
Essentially, yes. Until you eventually sell a property without doing another exchange, or potentially pass it on to heirs who may get a stepped-up basis. It's complex, professional help is absolutely essential, and under current law, it only applies to real estate, not other assets anymore.
Wow. Okay, one more tax angle. IRAs. Can you hold real estate in an IRA?
You can, though it's more complex than holding stocks or mutual funds. Real estate fits well with the long-term nature of IRAs. In a traditional IRA, your investment grows tax-deferred. You don't pay taxes until you withdraw the money in retirement. In a Roth IRA, contributions aren't deductible, but the growth and qualified withdrawals in retirement are completely tax-free.
Tax-free growth. Nice.
Very nice, especially over decades. It really accelerates compounding. You typically need a self-directed IRA custodian that allows alternative investments like real estate, and there are rules about not personally using the property or engaging in prohibited transactions. But yes, it's a powerful way to hold real estate for the long term.
Okay, the tax side is clearly powerful, but also intricate. Lots of rules. Which really brings home the point. Building a real estate portfolio isn't usually a solo act, is it? Having the right team seems crucial. Your sources lay out the key players. Real estate agent, lender, property manager, contractor, lawyer, CPA. That's quite a team. Out of all those pros, what's the biggest mistake you see new investors make when trying to assemble this team? And what's the real key to finding the right person for each role?
Yeah, the biggest mistake is probably trying to go cheap, or worse, thinking they can handle everything themselves, especially the legal and accounting stuff. Penny wise and pound foolish, you know?
Trying to save a few bucks up front costs way more later.
Exactly. The true North Star, the key to finding the right fit for every role, is seeking out professionals who specialize in working with investors. Our regular residential real estate agent is great for finding a family home, but an investor-focused agent understands things like cash flow analysis, cap rates, finding off-market deals, knowing rental regs. They speak your language. They're really the centerpiece of your team.
So specialization is key.
Absolutely. That investor agent helps find properties, maybe tenants, and they usually have a network of other investor-friendly pros, lenders, lawyers. They know the neighborhoods, the school zones inside out. Same with a lender. Get to know them early. Research options. A traditional bank or credit union might offer lower rates, but they'll likely want 20–30% down, stellar credit, cash reserves.
Right.
A hard money lender is faster, less paperwork, but you'll pay much higher interest, those upfront points, and they might only lend 50–70% LTV, meaning you need more cash down. You need a lender who understands investment property financing. Property manager. If you don't want to be a hands-on landlord, this person is vital. They handle the headaches, finding tenants, collecting rent, dealing with repairs, even evictions.
How do you find a good one?
Ask your agent. Ask other local landlords. Maybe even talk to tenants currently managed by a company you're considering. Get the inside scoop. Ask them tough questions. What are your fees? What services are included? What's your vacancy rate, eviction rate? How do you handle security deposits and owner funds? How often do you inspect properties?
Good list. Need to vet them carefully.
For sure. Contractor, especially crucial for flippers. You need someone reliable, experienced, licensed, and insured. No question. Treat interviewing them like a job interview. Watch for red flags. Are they late? Rude? Unwilling to provide a detailed written estimate? Do they ask good questions about the project? Do they return calls promptly? Do they claim you don't need permits when you probably do?
Big red flag, the permit thing.
Huge. Always get detailed written bids. Start and completion dates, work hours, total price, material specified, payment schedule, cleanup policy. And critically, tie payments to milestones, to specific completed tasks, not just calendar dates. Maybe include penalties for unreasonable delays.
Smart. Holds them accountable.
Then the real estate lawyer. Absolutely essential for setting up that holding company, that LLC or LP, to protect your personal assets. Also vital for reviewing purchase agreements, leases, and ensuring you have clear title to a property, especially if it's a distressed sale like a foreclosure. They handle title searches, deal with limits or inheritance issues, manage title insurance.
Okay, lawyer for protection and clean deals.
And the CPA, the Certified Public Accountant, a good one, especially one familiar with real estate, can mean the difference between paying a boatload of taxes and preserving more of your precious cash.
Because of all those complex rules we talked about.
Exactly. They help you choose the right business structure, LLC, S Corp, etc., set up budgets, track costs, maybe help secure financing, monitor profitability, handle payroll if you have employees. They're key for tax planning and preparation.
And what about overall financial advice? Brokerages.
Yeah, you've got different levels there. Online brokers offer DIY investing, low fees, research tools. Full-service brokers give you a dedicated advisor, more hand-holding, but for a higher fee. Some offer hybrid models. For really diving deep into real estate beyond just basic REITs, your sources suggest finding a fiduciary financial advisor.
Fiduciary meaning they have to act in your best interest.
Yes. And ideally, one who is fee-based or fee-only, not primarily earning commissions on selling you products.
Yeah.
Look for strong credentials, CFP, Certified Financial Planner, CFA, Chartered Financial Analyst, maybe a CPA or MBA, because honestly, many traditional financial advisors don't have deep expertise in the nuances of direct real estate investing or the more complex indirect options. They might just stick to REITs.
That's a fantastic breakdown of the team. Indispensable, really. And looking ahead, it's pretty exciting to see how real estate investing keeps changing, isn't it? Let's talk about some of those future frontiers gaining steam.
Yeah, definitely. One big one is eco-housing or green-habbing. Turns out going green isn't just good for the planet, it can boost the returns on your investment.
Gross.
Well, green renovations save energy, which lowers utility bills for owners or tenants. They reduce emissions, conserve water, all good things. But financially, studies show they lead to higher resale value. Like, your sources mention homebuyers willing to pay maybe $15,000 more for a house with solar panels.
Wow, tangible value add.
Right. And green features attract renters and buyers who increasingly care about sustainability. You see certifications like LEED, HERS, Energy Star becoming more common. Even big players, REITs like Camden Property Trust or Prologis, are focusing more on sustainable buildings because their investors are demanding it.
Okay, so green is good for the wallet too. What else is on the horizon?
Blockchain technology. This could be truly revolutionary for real estate.
Blockchain, like Bitcoin. How does that apply here?
Well, the underlying technology, that secure, distributed, encrypted ledger, has huge potential to make real estate transactions much more efficient and transparent. Think about speeding things up, reducing costs by cutting out some middlemen, allowing direct money transfers securely.
Right.
It could dramatically simplify things like verifying ownership and doing title searches. Imagine a Carfax for homes where the entire history of a property ownership, liens, permits, is securely recorded on the blockchain, instantly verifiable.
That would be amazing.
Yeah.
Title searches can be slow and costly.
Exactly. And it could also bring liquidity to what is traditionally a very illiquid asset class through something called tokenization.
Tokenization.
Yeah, basically breaking down ownership of a property into digital tokens that represent shares. These tokens could then potentially be traded more easily, maybe on specialized online exchanges, making it easier to buy or sell fractional ownership in real estate. It's still early days, needs infrastructure and regulation, but the potential is huge.
Tokenization, making big, illiquid assets divisible and easier to trade.
Yeah, that sounds like a potential game changer. So, beyond knowing these trends exist, how could a regular investor, maybe someone new, actually start to capitalize on eco-housing or blockchain right now, even if they aren't an expert? And are there any other sort of frontier areas bubbling up we should watch?
Good question. For eco-housing, it can be as simple as prioritizing energy-efficient upgrades when you renovate a rental or flip. Look for good insulation, Energy Star appliances, maybe properties with potential for solar. Even without full certification, these features appeal to tenants and buyers, and they lower running costs, so you can market that benefit.
Okay, practical steps.
For blockchain, it's still pretty nascent for direct individual investment, but keeping an eye on those crowdfunding platforms or new fintech companies exploring blockchain for real estate transactions or fractional ownership, that's where you might see the first accessible opportunities emerge. Look for platforms emphasizing transparency or using tokens.
Got it. Watch the innovators. As for other frontiers, definitely watch the trend towards smaller living spaces in expensive cities, micro-apartments, co-living spaces that offer shared amenities, catering to affordability and community needs.
Right, changing lifestyles.
And anything related to facilitating remote work. Properties with dedicated home office spaces, strong, reliable internet infrastructure. That's become a major selling point and likely isn't going away. Investors who cater to that need could do well.
Fantastic insights. We've really covered a lot of ground today, haven't we? From the fundamental why of real estate, its tangibility, scarcity, diversification to all the different property types. We unraveled the direct paths like renting and flipping and the whole universe of indirect options like REITs and crowdfunding. We looked at those big external forces, the economy, demographics, government action, dived into the sometimes confusing but really valuable world of taxes, and mapped out that essential team of pros you need in your corner.
Yeah, it's a big landscape. And if we connect it all back, the old saying is location, location, location. And that's still vital, of course. But looking ahead, really mastering real estate investing might increasingly depend on understanding those deeper currents. Anticipating demographic shifts like that senior co-housing trend, embracing new technologies like blockchain and tokenization, and really understanding evolving human needs not just for shelter but for community, sustainability, flexibility, like with remote work. The basic need for housing and space isn't going away, but how we use space, what we value in it, that's constantly being reimagined.
That's a great way to put it. So as you, our listener, think about your own path in real estate, maybe ask yourself, beyond just the numbers and market cycles, how could a deeper understanding of people, communities, and these new innovations unlock the next big opportunity for you? Lots to think about. We definitely encourage you to keep exploring.